Are we going to have a nice Christmas in the financial markets? Equity remain in a bull mode, but probably not in a straight line. And we will see there are a few canary in the coal mine, even though the big theme rotation in favor of value into growth is going to remain, and possibly some reflation trade. So 2 weeks ago, we were at 30.80 on December 3rd about, and we said we were going to be very brave. We'll hope that we have a double test of this 30.80 level and then it will rise. Well, it didn't give the second chance to buy at 30.80. It went straight up from that day, making higher highs almost every day in the last 2 weeks. And we notice here on these weekly charts, on these monthly charts, that the prices of the close of November was above the Bollinger Band, that the Bollinger Bands are rising since now 4 months, and that the similar situation which occurred in 2016 or at the end of 2012 is inducing investors to believe that we will have a very long, prolonged linear uptrend. Well, I may disagree, and we will come back in January about that, because I believe that year in 0 and 1 are much more volatile than the year which ends with a 9. Which is the year we are finishing now. So don't be surprised if I expect the volatility VIX to sometimes break its downtrend and move higher during 2020. Now, we know so far in the US everything is fine. We've presented this chart already, which is the breadth of the market, the participation of all the different sub-segments, small cap, mid cap, together with the large caps. And this cumulative line, cumulative red line, was doing higher highs and calling in advance higher highs for the New York Stock Exchange, which has just been done before Christmas last week. So another Christmas gift. Further, the rotation from growth into value, which is represented by this black line when this black line is descending, because we have worldwide the growth stocks divided by the value stocks index. And we see that since December 3rd, this uptrend outperformance of value has resumed. Okay, the ratio is coming down, growth is underperforming value. So this theme is going on. In addition to that, emerging markets, which were kind of lagging, they were in a kind of a descending triangle or symmetrical triangle here. They broke it in mid-October after the other markets, after the US market, and now even in the last 2 weeks they make a new high and break a key resistance which was the top of the year 2019. Opening, of course, not only something like 5 to 6% higher, but probably opening the potentiality to rise, to reach the 2018 high. And this is very good news, because this relative strength line here in orange was going down versus the S&P 500. That means people are out of emerging market and have been only focused or buying back more developed market, especially the US market. So people are going to be induced to go back into this risky asset class, which is supposed to be the most risky one, except when it goes up strongly. The other element that we noticed is that suddenly many American investors are interested in the Europe. They have seen also, like for the emerging market, a declining relative strength of Europe versus S&P 500, and they noticed already in October or right now some kind of bottoming action, and they like this price pattern, which is breaking out of also a symmetrical triangle towards a new high, and they hope that we are going to take, of course, the 2018 high in the coming months of 2020. And the momentum is not bad. The momentum is also accompanying this movement. And we see that in December 3rd, we had a quick spike and immediately people went to buy back and nurture this uptrend with higher highs. Also, a similar situation is present in Japan. We noticed now for the last 4 previous months that we are closing higher every time, even though we are reaching the upper Bollinger Bands, we are close to the former highs, and as in other markets, once we break these resistances, people are projecting a move higher, probably also of 10% minimum or 15%. Momentum is strong, and people who had seen the Nikkei underperforming the S&P 500 notice that it has risen steadily since the mid-summer, slowly but steadily on a relative strength basis, and they expect also the yen to continue possibly on a weaker side, as represented by the orange line here. At least the yen is not rising, it's about flat, slightly coming down, and they expect that a weaker yen will propel the Japanese equity up, like usually it is the case. Now, we do have a few canary in the coal mines. If we look very short term, and this is a daily chart of the yen index, we had, with the recent increase in prices of the Nikkei, here that we have in the black dotted line, a strong move up. We had, of course, a decline of the yen, so a weakening yen currencies. But if you look at what happened in the last few days, you notice that we are basically within a long descending wedge in red here. And it's possible that we might have a little bit of a trouble in the coming days up to the end of the year, like a rebound could be correlated with some profit taking short term. Also, if we look at Euro-Swiss, we notice that already in the last 4 or 5 days, the Euro-Swiss refused to move up. That means the Swiss franc is getting a bit stronger. That could possibly be related to Brexit. That means there was more chance of a hard Brexit, or it could be the canary in the coal mine just telling you that maybe some profit taking is going to occur within the S&P 500. A further area of concern could be also the rising yield. Of course, we have been of the opinion that yield in the 10-year US market is going to rise since about mid-September, let's say. And we have still a target of 214. However, the recent rise in the last 2 weeks, which occurred as expected, is not very dynamic. It's not very strong. It has not broken yet the 197 resistance level, and a failure to do so right away before the end of the year could allow some pullback toward the clouds, not very dramatically, but maybe a little pullback coming together with some profit taking on the S&P 500. We noticed short term that financial will have been outperforming, utilities just taking a little pause. So that could also reinforce the possibility of some profit taking. That the so-called industrial sector, which was expected to outperform the discretionary sector with the trade truce and so on, is having some trouble. Of course, it is also linked to the trouble of Boeing, which is one specific stock having a strong influence on the industrial sector. And when we zoom in the sentiment, we looked at what is the price of options 3 months from now, not 1 month, but 3 months out from now. We noticed that the VXV, is not only hitting some support here around 14%, 1475, but is also making a little pattern called an island reversal, which could lead to some rebound in the last 2 weeks of the year. We see that the strong decline of the VIX, VXV also from December 3rd at 18% to 14% has brought us back to oversold area, and so a rebound would not be a surprise. So don't be surprised at all if I say that maybe we already opened our Christmas gift for the S&P 500 by reaching 3,200, and maybe some profit taking is going to take place, or some volatility is going to occur from now on up to the first week of January. A pullback would go probably, if it has been minor, toward 3150. If it is a little bit more major, it could then retest the 3070 spike low that we saw at the beginning of December. And with that, I wish you all a very Merry Christmas and festive season.